experience and observation extending over 50 years, we have not known a single person who has consistently or lastingly made money by thus following the market. We do not hesitate to declare that this approach is as fallacious as it is popular. Since its first publication in 1949, revisions of The Intelligent Investor have appeared at intervals of approximately 5 years. In updating the current version, we shall have to deal with quite a number of new developments since the 1965 edition was written. The underlying principles of sound investment should not alter from decade to decade, but the application of these principles must be adapted to significant changes in the financial mechanisms and climate. We have not allowed these fluctuations to affect our general attitude towards sound investment policy, which remains substantially unchanged since 1949. The extent of the market shrinkage in 1969 and 1970 should have served to dispel an illusion that had been gaining ground during the past 2 decades. This was that leading common stocks could be bought at any time, at any price, with the assurance not only of ultimate profit, but also that any intervening loss would soon be recouped by a renewed advance of the market to new high levels. That was too good to be true. At long last, the stock market has returned to normal, in the sense that both speculators and stock investors must again be prepared to experience significant and perhaps protracted falls as well as rises in the value of their holdings. In the area of many secondary and third-line common stocks, especially recently floated enterprises, the havoc wrought by the last market break was catastrophic. This was nothing new in itself. It had happened to a similar degree in 1961-1962. But there was now a novel element in the fact that some of the investment funds had large commitments in highly speculative and obviously overvalued issues of this type. Evidently, it is not only the tyro who needs to be warned that while enthusiasm may be necessary for great accomplishments elsewhere, in Wall Street, it almost invariably leads to disaster. The major question we shall have to deal with grows out of the huge rise in the rate of interest on first-quality bonds. Since late 1967, the investor has been able to obtain more than twice as much income from such bonds as he could from dividends on representative common stocks. We have consistently urged that at least 25% of the conservative investor's portfolio be held in common stocks, and we have favored in general a 50-50 division between the two media. We must now consider whether the current great advantage of bond yields over stock yields would justify an all-bond policy until a more sensible relationship returns, as we expect it will. Naturally, the question of continued inflation will be of great importance in reaching our decision here. In the past, we have made a basic distinction between 2 kinds of investors to whom this tape was addressed: the defensive and the enterprising. The defensive, or passive investor, will place his chief emphasis on the avoidance of serious mistakes or losses. His second aim will be freedom from effort, annoyance, and the need for making frequent decisions. The determining trait of the enterprising, or active or aggressive investor is his willingness to devote time and care to the selection of securities that are both sound and more attractive than the average. Over many decades, an enterprising investor of this sort could expect a worthwhile reward for his extra skill and effort in the form of a better average return than that realized by the passive investor. We have some doubt whether a really substantial extra recompense is promised to the active investor under today's conditions. But next year, or the years after, may well be different. It has long been the prevalent view that the art of successful investment lies first in the choice of those industries that are most likely to grow in the future, and then in identifying the most promising companies in these industries. For example, smart investors, or their smart advisors, would have long ago recognized the great growth possibilities of the computer industry as a whole, and of international business machines in particular, and similarly for a number of other growth industries and growth companies. But this is not as easy as it always looks in retrospect. Such an investor may, for example, be a buyer of air transport stocks, because he believes their future is even more brilliant than the trend the market already reflects. For this class of investor, the value of our tape will lie more in its warnings against the pitfalls lurking in this favored investment approach than in any positive technique that will help him along his path. The pitfalls have proved particularly dangerous in the industry we mentioned. It was, of course, easy to forecast that the volume of air traffic would grow spectacularly over the years. Because of this factor, their shares became a favorite choice of the investment funds. But despite the expansion of revenues at a pace even greater than that in the computer industry, a combination of technological problems and overexpansion of capacity made for fluctuating and even disastrous profit figures. In the year 1970, despite a new high in traffic figures, the airline sustained a loss of some $200 million for their stockholders. They had shown losses also in 1945 and 1961. The stocks of these companies once again showed a greater decline in 1969 and 1970 than did the general market. The record shows that even the highly paid full-time experts of the mutual funds were completely wrong about the short-term future of a major and non-esoteric industry. On the other hand, while the investment funds had substantial investments and substantial gains in IBM, the combination of its apparently high price and the impossibility of being certain about its rate of growth prevented them from having more than, say, 3% of their funds in this wonderful performer. Hence, the effect of this excellent choice on their overall results was by no means decisive. Furthermore, many, if not most of their investments in computer industry companies other than IBM appear to have been unprofitable. From these two broad examples, we draw two morals for our listeners. 1. Obvious prospects for physical growth in a business do not translate into obvious profits for investors. 2. The experts do not have dependable ways of selecting and concentrating on the most promising companies in the most promising industries. The author did not follow this approach in his financial career as a fund manager, and he cannot offer either specific counsel or much encouragement to those who may wish to try it. What then will we aim to accomplish in this tape? Our main objective will be to guide the listener against the areas of possible substantial error and to develop policies with which he will be comfortable. We shall say quite a bit about the psychology of investors, for indeed the investor's chief problem, and even his worst enemy, is likely to be himself. The fault, dear investor, is not in our stars and not in our stocks, but in ourselves. This has proved the more true over recent decades, and it has become more necessary for conservative investors to acquire common stocks and thus expose themselves, willy-nilly, to the excitement and the temptations of the stock market. By arguments, examples, and exhortation, we hope to aid our listeners to establish the proper mental and emotional attitudes toward their investment decisions. We have seen much more money made and kept by ordinary people who are temperamentally well-suited for the investment process than by those who lack this quality, even though they had extensive knowledge of finance and stock market lore. Additionally, we hope to implant in the listener a tendency to measure or quantify. For 99 issues out of 100, we could say that at some price they are cheap enough to buy, and at some other price they would be so dear that they should be sold. The habit of relating what is paid to what is being offered is an invaluable trait in investment. In an article in a woman's magazine many years ago, we advised our readers to buy their stocks as they bought their groceries, not as they bought their perfume. The really dreadful losses of the past few years, and on many occasions before, were realized in those common stock issues where the buyer forgot to ask how much. We shall therefore present in some detail a positive program for common stock investment, part of which is within the purview of both classes of investors, and part is intended mainly for the enterprising group. Strangely enough, we shall suggest as one of our chief requirements here that our listeners limit themselves to issues selling not far above their tangible asset value. The reason for this seemingly outmoded counsel is both practical and psychological. Experience has taught us that while there are many good growth companies worth several times net assets, the buyer of such shares will be too dependent on the vagaries and fluctuations of the stock market. By contrast, the investor in shares, say of public utility companies,